A lot of it is talking to clients about interest rates, where the market is, what's happening, and what they need to prepare for. And I want to make sure you guys are preparing clients with a perspective, a change of mindset, right? I mean, we're not in a 2.25% rate environment anymore. And it's about having the conversations with the client more or less in setting the tone as to saying, you know what, we're in an amazing interest rate environment, which means your dollar, the money that you make, will get you further, right, in the purchase price of home that you want and the ability to have more money left over for savings. And with interest rates in the threes, this is something that you can be totally excited about, especially as a renter when you're paying 100% on your interest rate. So let's talk about what we're seeing right now in the market. We're still getting clients right now. There's certain clients, certain down payments, certain credit scores. We're still finding ways to get those clients into the twos. 2.875, we're still there, right, with some. Others, we're just not, right? I mean, the credit scores, if they're low, if we're not in the right down payment scenario, they may be pushing, if they don't want any points, they're gonna be pushing a 3% interest rate. And literally, before I started changing some of the scripting and conversations I was having, people are like, no. I mean, that's just ridiculous. I want an interest rate in the twos. I'm not gonna buy unless the interest rate's in the twos. I'm like, okay, well, let's really just frame this properly. You're renting, you're paying 100%. So you're telling me that 2.875 would get you to buy, but 3% wouldn't. And it's breaking that down a little bit with them, but then also showing them, when I get into these conversations, the delta in what that changes their monthly payment and how long they're planning on living in the house. Most people think, okay, well, this is a 30-year impact. Oh, that's awesome. Well, yeah, it could be, but how long do you plan on keeping the house? And I try to get that question answered early on so they can't come back and change it down the road in the conversation. Well, this is a 30-year stay. No, we talked about this being a 7-year stay. So that $11 times 12 months times 7 years is X dollars. So that's really not a big number when you still consider the fact that if you want to keep renting, you're paying 100% of your money to the landlord. The other thing I try to get out in my conversations early on is how they're doing with their jobs. How are they feeling? How's their company feeling? Are they starting to work more hours? Are they feeling more comfortable getting out and about? Because that sets up the tone of, okay, just like you are, so is everybody else. And when you have everybody else doing the same thing that you are, you have people being confident. A confident consumer means they're willing to spend more money, which ultimately will trend rates higher, right? Because that's just the way the market cycles. Pandemics, that's what drives the interest rates down. Confidence on the flip side tends to bring interest rates up. So I have those conversations in advance because if I find that the client is really focused on only going towards that lower rate market, I can go back to that conversation and say, well, just like we were talking about earlier with you being really confident, making more money, working more hours, you're seeing everything coming back, so is everybody else. And that's what's driving up interest rates. So before the pandemic, we were in a market rate environment of 3.5 to 3.75. Today, we're not quite there yet, but because everybody's getting confident, guess what's gonna happen? It's gonna trend back up that way. So let's make sure you get in before that trend happens. You're ready to make a decision to buy a house. For those that can still get into the twos, I mean, we're still driving those and they're typically the higher credit scores on conventional, putting more money down. They're able to drive into the twos. FHA with higher credit scores can still get into the twos. VAs with the higher credit scores can still get into the twos. It's just the ones that are down in that 620 space. So what are we kind of projecting right now? There's still really good opportunities in this short term, meaning March, April, maybe May, to see rates pretty much stay where they are. Maybe some ups and peaks and valleys, some cycles where they could still get the 2.875 or the 3.25 rate, but they will either pay a little bit less or a little bit more depending on how the market's doing. So we do expect rates to still stay for the next month or two in the range that we're in now. We have to be careful because we're at a 1.5% inflation mark with these types of rates. All the news is that we're fully expecting higher inflation to come about, which when higher inflation comes about, interest rates are going to go up. So we could see us trending June, July back to those higher 3.5+% rates if we do get the type of inflation they're talking about at 2.5%. The thing that we really got to look at then is what's going to happen in 2022 and 2023. Because with all this market movement and inflation going up, and you see what's happening with prices of homes and demand, do we talk about recession? Right? Do we talk about a slowing economy and what's going to happen? And then at that point, and if we do get to that point, obviously interest rates will counterbalance that and they'll drop. It's just the facts. And the biggest fact of all is we're still in some of the most historically low market rated interest rates that we've ever seen. And no matter what rate it is, 7.5% or 8% is still lower than people paying rent.